Hey, everybody. Welcome to Storytelling of the Market, Chapter 2. We're very excited to deliver this second chapter to you. In the first chapter, Stories of the Market, or Market Storytelling, we learned about the S&P 500. And you should see this on our blog post as well as our YouTube channel. It's probably sitting right next to this one. Now, we're going to reveal secrets on how to get higher returns in a smart and prudent way. And of course, everybody wants to know about higher returns. So here we go. Now, as a reminder, last time we looked at S&P 500, and if you recall, we looked at that bottom left-hand corner of the chart. And the reason why we do that is that's where we have the most data. So down here in the very bottom left-hand corner, we have the data from the beginning of 1926 to the end of 2019, 10.2%. We'll just call it 10% is the large cap expected return. Okay, so what if we wanted to do better than that? Well, let's look at US small cap expected return. And if we look at the same, almost the same day period, apparently for this data, we don't have solid data, 1926, 1927. So we start with 1928. So we just have 2 years less data here. But from the beginning of 28 to the end of 2019, 11.9% annualized return. So we're beating the S&P 500 by almost a full 2%. That's awesome. We will take that absolutely anytime. Now, there may be more volatility, but that's a whole other story, but probably not that much more. And now, in addition, we just looked at the what we call premium, the increased return of small versus large. What about the increased return of comparing value and growth? So on the left-hand side, we have a few things listed about value stocks, and on the right-hand side about growth. And value and growth has to do with the ratio or the comparison of the price in the stock market versus the actual accounting value that you would see in the accounting statements from the company. So growth stocks are those that have been bid up in the marketplace. Whether they should have been or not is another story. And value stocks are the ones that haven't been bid up, or maybe in fact have been bid down. Again, whether that's the right thing or not is another story. So the value has a lower price relative to its book value, and growth has a higher price relative to its book value. Now, a value stock could be a former growth stock in tough times, and vice versa. A growth stock could be a former value stock in good times. But value, typically, the way we think of value is having less pizzazz. It's less known. It's not as exciting. Maybe the products aren't very exciting. Not good companies. They're good enough to have gotten large enough to go public, and they're an ongoing public concern. But maybe they're just not exciting. On the other hand, growth stocks tend to be exciting stocks. They're well known. A lot of mutual fund managers buy them in part just because the general public expects them to have bought them. And they don't want to not have that stock in their list, which is kind of a dumb reason to buy a stock, but that's what happens. Now, a good example of this is back in the 80s, there was Motorola stock that was famous for cell phones at the time when cell phones were emerging incredibly strongly as an important product. And then there was another stock for Hormel meats and chili. Hormel, Spam, not spam like computer spam, but Spam, the actual Spam yeet. And it was interesting because they did a study comparing those two, and the higher performer in the stock market was Hormel, which was the value stock. And so, yeah, value stocks tend to beat growth stocks long term. Now, just like any asset class out there, any asset class can go out of favor and come back in favor, back and forth. And that happens with value and growth as well, which is what these last 2 points on the screen are about. So moving on here. Now let's add not only the small factor, but the value factor as well. And so now these are US small value stocks. So we're adding both benefits of being small and being value. And when you look at that same stream of data, 13.2%, so almost another 1.5% higher than where we were a moment ago. And so now, what about the lost decade? Let's take a look at that. So during the lost decade, if you remember from the first video, US large had a negative 0.9% annualized return. Well, lo and behold, US small value had an 11.2% positive annualized return during that same time period. So had you been diversified and you had some exposure to US small value, you would at least had some of your portfolio do quite well. Now let's talk a little bit about the growth of a dollar And that's this part that we haven't talked about yet, this little chart here. I'm not going to show it expanded, but this just shows how when you have this same data for the S&P 500, this is how $1 grows over the entire time period. But we're going to look at it in a chart here. So if we look at the S&P 500 at about a 9.9% return during this time of 1928 to 2019, $1 grows to 5,900. And I'll explain this last column in a second. In the large value at 11.2% annualized return, that grows to $1 grows to 17,000 and some change. And then small value 11.9, it grows to 32,000 and some change. And then look at small value at 13.2, 90,000 and some change. So you can see that these small changes in return, when compounded over a long period of time, makes a huge amount of difference. But how many of us were able to invest from 1928 to 2019? Well, probably not many. But what about a typical situation of a 401k? So let's look at a 401k, and let's just suppose 5,000 was put in there per year for 35 years for someone from age 30 to 65. And let's say that we're using the S&P. Oh, no, I'm sorry. That's a note about the different data. Okay. And if you are getting these same returns of 9.9, 11.2, et cetera, and you're also putting in 5,000 a year, how much does that difference in returns matter in terms of how much money you save when you're saving 5,000 a year in this 401k, which I'm calling the 401k index? Well, we'll just do the lowest one and highest one to save some time here. So with the S&P 500, only 1.37 million you would have after that 35 years. But if you'd done only small value, which we're not suggesting that you should put all your eggs in one basket, but if you did, you would have 2.91 million, more than double that you would have had if you're in the S&P 500. So that's why it's so critical to have a smart, diversified portfolio, because you want to keep compounding well over time and not have bad years in there. So this is really illuminating, I think, to just see how important it is to allocate the money in your 401k plan properly. So what did we learn today? That the U.S. large expected return we reviewed and recalled that was around 10%, and that large value is the expected return of about 11.2%. Small expected return alone is about 11.9. We actually didn't separately look at a large value, by the way, but that's what it is in case you were interested. And then we also looked then at combining both of those virtues of small and value, and it went up to 13.2%. So we basically proved that over the long haul, small stocks outperform large stocks, and that value stocks outperform growth stocks. During the last decade, when U.S. large, as represented by the S&P 500, had a negative return for an entire 10-year period, small value was at 11.2% positive. So diversification is very important, and we will push that diversification idea some more in future videos, and I look forward to sharing those with you. Thanks for being here today. God bless you. Have a great day. Bye-bye.